In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about SEBI's new draft circular on algo trading. I then discuss the growing debt problem for developing countries. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your host, Kashish Kapoor. Today is Tuesday, 17th of December. You can find us on Spotify, Apple Podcasts, or wherever you consume your podcast. The Daily Brief is also available in Hindi. And if you like reading instead of watching and listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the show notes. So let's start with the first story. SEBI has proposed a new framework to make algo trading more inclusive for retail investors while ensuring the integrity of the market. This is in response to the increase in algo trading among retail investors and also the rise of several unregulated algo platforms that were promising unreasonable returns. For context, algo trading uses computer programs to execute trades based on specific instructions. As a simple example, an algo can be set to buy a stock if its price crosses 100 rupees and sell if it falls below 95 rupees. This eliminates the need for constant manual monitoring and ensuring faster execution. But in reality, these algorithms can be infinitely complex. The advantage lies in speed and discipline. Algorithms can analyze huge amounts of data and place orders in milliseconds, far quicker than any human can. They also remove emotion from the trading decisions, sticking strictly to programmed rules. In India, algo trading accounts for about 70% of total market volumes. Now, this seems like a lot, right? But you see, most of these volumes don't come from retail, but market participants like high-frequency traders and etc. Here's what the latest draft circular says. Brokers must obtain stock exchange approval for every algo before deployment. Each approved algo will be tagged with a unique identifier for better traceability and auditability. SEBI divides algos in two types. First, white box algos, fully transparent where users know the logic and can replicate it. Second are black box algos. These are proprietary and opaque, often used by institutions. These will face stricter oversight with algo providers requiring to register as research analysts and maintain detailed reports. Retail investors who create their own algos can register them through brokers, but these can only be used for personal or family trading. Brokers offering APIs must ensure robust authentication methods like two-factor verification and limit API access to authorized users with unique keys. Stock exchanges will monitor algo trades post-execution and will have the authority to halt malfunctioning algos using a kill switch. They are also tasked with ensuring that brokers distinguish between algo and non-algo orders. Let me give you some historical context on algo trading in India to understand why SEBI is focusing so much on this. Algo trading began in India in 2008 when SEBI introduced direct market access, that's DMA. This allowed institutional investors to bypass brokers and place orders directly into the exchange systems. It gave them faster execution and better control over their trades. Over time, exchanges like the NSE started offering co-location services where traders could place their servers closer to exchange systems, further reducing execution delays. In the early days, algo trading was limited to institutions like mutual funds, hedge funds, and proprietary trading desks. By 2012, SEBI issued its first ever guidelines for algo trading, focusing on risk management and preventing market manipulation. In recent years, algo trading has expanded beyond institutions. Brokers introduced APIs that allowed tech-savvy retail traders to connect their own algorithms to trading systems. Additionally, platforms made it possible for retail investors to build and test algo strategies without needing to code. In 2021, SEBI released a consultation paper to address rising retail interest in algo trading and the risks associated with unregulated platforms. The paper proposed requiring all algos to be pre-approved by exchanges and placing the responsibility of compliance squarely on brokers. It was one of the first attempts to regulate retail algo trading comprehensively. By 2022, SEBI had issued a circular banning brokers from partnering with unregulated algo platforms. These platforms had gained popularity for offering pre-built strategies with misleading claims of guaranteed profits. The circular also prohibited performance claims for algos and emphasized greater transparency to curb mis-selling. These steps were critical in laying the groundwork for latest draft circular. This democratization has driven retail interest in algo trading. However, it also raised concerns about misuse. Many unregulated platforms began offering pre-built strategies with misleading claims of guaranteed returns. Retail traders, often aware of the risks, could end up deploying poorly designed or manipulative algos, leading to financial losses or market disruptions. While algo trading brings speed and efficiency, it also comes with risks. Misuse of algos for manipulative practices like spoofing, where placing fake orders to manipulate prices, has been a recurring issue. Poorly designed algorithms can also malfunction, causing flash crashes or other market disruptions. These risks underscore the need for strong oversight, which SEBI has been working to address over these years. And now, on to the next story. Emerging markets are drowning in $29 trillion of debt, with $850 billion going towards interest payments every year. Even more concerning, this public debt is growing at twice the rate in developing countries compared to developed ones. That's just not a big number. It's the kind of number that makes your calculator flash error. But before we start blaming debt as the ultimate villain here, let's pause and add some much needed context. Because as with most things in life, debt isn't just black and white. Let's get this straight. Debt isn't inherently bad. Think of it like coffee. It's fantastic in moderation, but it can also become a reason for your sleepless and restless nights if consumed in excess. In fact, debt can be both good and bad. Developed nations like the US or Japan use debt to fund productive investments. Think infrastructure, innovation, and capacity building. These investments fuel economic growth and make their countries stronger over time. As long as their economies grow faster than their interest payments, they are more or less in the safe zone. The US has over $33 trillion in debt, and Japan's debt to GDP ratio is staggering 250%. Yet, investors aren't losing sleep over them. Why? Because their economies are large, stable, and have a strong record. But that is not the case with every other country in the world. Now flip the script. For emerging economies, debt isn't just a number, it's a crushing weight. Developing countries hold just 30% of global public debt despite being home to nearly 80% of world's population. So while their debt levels may seem small in absolute terms, that burden is disproportionately heavy. For example, 54 developing countries spend more than 10% of their revenues just on interest payments, with more than half of these in Africa. Here's a weird yet telling example. Sri Lanka versus the US. The US owes 330 times more debt than Sri Lanka, but Sri Lanka is considered riskier. Why? Because most of Sri Lanka's debt goes towards repaying old loans, not building new infrastructure or boosting their economy. And this has a devastating ripple effect. Many developing countries spend more on debt servicing than on healthcare and education combined. In Africa, for instance, per capita spend on debt interest is $70, while health spending is just $39. That's not just unsustainable, it's literally human tragedy. So why does debt weigh so much more on developing countries? We can partially blame it on the broken international financial system. First, it's all about sky-high borrowing costs. Emerging markets pay 2 to 12 times higher interest rates than developed nations. Why? Because these are risky countries and investors need the compensation for taking the risk. Second would be reliance on foreign creditors. With limited domestic savings, these countries depend on foreign creditors. And here's the catch. This debt has to be paid in hard currencies like the US dollar. And what's the result? Half of developing countries allocate at least 6.3% of their export revenues just to service debt. And finally, it's also about private creditors who don't play nice. About 61% of external debt in developing nations is owed to private creditors. These are banks, hedge funds, and other financial institutions. These lenders charge higher rate of interest and are notoriously difficult to negotiate when it comes to restructuring their debt. They're here for the money and not economic recovery. So, what is the path forward then? All this data is from the UN's 2024 World of Debt report, and it just doesn't dwell on the problem. It also tries to offer some solutions. They propose a roadmap to finance sustainable development focusing on 3 key actions. First, to reduce the cost of debt with affordable financing options. Second, scale up long-term investments, especially in areas like infrastructure and climate action. And finally, improve global financial systems to include developing nations in the decision making process. And here's the thing, debt, when used right, is definitely a powerful tool. But without structural reforms, the current system will keep pulling resources away from where they're needed the most. That's hospitals, schools, and climate initiatives. So the next time when someone says, debt is bad, ask them, who's debt? Because for the US, it's a superpower flex. But for Sri Lanka or Nigeria, it's a full blown crisis. And if global leaders can't fix this imbalance soon, we might find ourselves asking even scarier questions. What happens when the debt finally becomes too much to handle? And now on to the tidbits for the day. First, IndusInd International Holdings Limited is set to finalize its 9,861 crore acquisition of Reliance Capital by January 2025, resolving one of India's major IBC cases. The deal involves debt repayment by 2026-27 and the strategic listings of subsidiaries, strengthening IndusInd's financial sector footprint. Number two, Apollo Tyres is tackling natural rubber shortages and price volatility by adopting recycled rubber and bio-based materials, targeting 40% sustainable sourcing by 2030. This pivot reduces dependence on natural rubber, aligns with global sustainability goals, and mitigates cost pressures. And finally, India's private sector PMI surged to 60.7 in December 2024, led by services and manufacturing growth. Employment hit record highs, and easing inflation improved economic prospects, signaling robust momentum for 2025. And that's it for the day. I'm your host, Kashish Kapoor. This was the Daily Brief, and I'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.